Have you ever wondered which investment avenue is the best for you? Investing is a vital part of financial planning. It's not only about growing your wealth, but it's also about securing your future and achieving your financial goals. But with a plethora of investment avenues available today, how do you decide which one is the best for you? Well, that's where the importance of comparison comes into play. Comparing different investment avenues is like shopping around for the best deal. It helps you understand the various options available and how they align with your financial goals. When comparing, there are a few key factors to consider: the risk involved, the return on investment, the level of liquidity, and other factors such as tax benefits and time horizon. Each investment avenue has its own set of characteristics that can either make it a suitable choice or a risky proposition. In this video, we will compare different investment avenues to help you make an informed decision. Let's begin with one of the most popular investment avenues: stocks. Imagine owning a piece of a company you believe in. That, in essence, is what buying stocks is all about. When you purchase a stock, you're buying a small slice of that company, becoming a shareholder in the process. This entitles you to a share of the company's profits, typically paid out in dividends, and gives you the right to vote on certain company matters. The allure of investing in stocks lies primarily in the potential for high returns. Companies often reinvest their profits to grow, innovate, and expand their operations. As a result, the value of their stock can increase over time, providing shareholders with capital gains. Some have even managed to turn a modest investment into a fortune. However, the stock market isn't a one-way street to riches. It's also a place where prices can fluctuate wildly and where even the most solid companies can experience downturns. This volatility is one of the main risks of investing in stocks. The value of your investment can decrease as well as increase, and there's a possibility that you could lose your entire investment. Yet, one of the advantages of stocks is their liquidity. Stocks can typically be bought or sold on a public exchange at any time during market hours. This means you can quickly convert your investment into cash if needed, a feature that's not always available with other types of investments. So, who might choose to invest in stocks? It's an avenue often chosen by those who have a high risk tolerance and seek potentially high returns. This might be someone who's investing for the long term, who understands the ups and downs of the market, and who's prepared to weather any short-term losses in anticipation of long-term gains. In summary, investing in stocks can be a rewarding venture, but it's not without its risks. It requires a willingness to take on risk, a commitment to stay informed about your investments, and the patience to weather the market's inevitable ups and downs. So, if you're an investor with a high risk tolerance seeking potentially high returns, stocks could be a suitable avenue for you. Next up, we have bonds. Now, you might be wondering, what exactly is a bond? In simple terms, a bond is a loan that you, as an investor, give to the issuer. This could be a corporation, a municipality, or even a government. In return for your loan, the issuer promises to pay you a fixed rate of interest over a specified period and to return your principal amount at the end of that period, also known as the bond's maturity date. So, how does one make money from bonds? Well, there are two primary ways. First, you receive interest payments, typically twice a year, for the life of the bond. Second, if you sell the bond for more than you paid for it, you make a capital gain. But remember, investing in bonds is not without risks. While bonds are generally considered less risky than stocks, they are not risk-free. The main risk is that the issuer might default, which means they can't or won't make their interest payments or return your principal. Also, bonds can be less liquid than stocks, meaning they can sometimes be harder to sell at a fair price. Another risk to consider is interest rate risk. If interest rates rise, the price of existing bonds falls. Why? Because new bonds will be issued with higher interest rates, making existing bonds with lower rates less attractive. So, who might choose bonds as an investment avenue? Typically, it's those who prefer a lower risk and a steady stream of income. This could include retirees seeking a reliable income stream or conservative investors who want to preserve their capital while earning a modest return. In summary, bonds offer a relatively low-risk way to earn a steady income. They might not offer the high returns of stocks, but they also don't carry the same level of risk. And remember, a well-diversified portfolio typically includes a mix of stocks, bonds, and other assets. Therefore, if you prefer lower risk and steady income, bonds might be your go-to investment avenue. Moving on to another popular investment avenue, mutual funds. Imagine being able to invest in a wide variety of stocks, bonds, and other securities, all managed by a professional without needing to do the heavy lifting. That's what mutual funds offer. They pool together money from multiple investors to invest in a diversified portfolio. This diversification helps to spread the risk and potentially enhance returns. Mutual funds work in a pretty straightforward manner. You buy units of a mutual fund and your money is then invested in a range of securities chosen by the fund manager. The fund manager is a professional who decides where to invest your money based on the fund's objectives and market conditions. So you're not just investing, you're leveraging the expertise of a professional. The potential returns from mutual funds can vary. Some funds focus on growth and can deliver high returns, albeit with higher risk. Others may focus on income, providing steady, albeit lower returns. It's important to understand that all investments, including mutual funds, come with risks. The value of your investment can go up or down depending on market conditions. Liquidity is another important aspect of mutual funds. Most mutual funds allow you to buy or sell your units on any business day, providing a high level of liquidity. This means you can access your money when you need it. So who might choose mutual funds as their investment avenue? Well, they can be a good choice for almost any type of investor. If you're new to investing and want a diversified portfolio without the hassle of picking individual stocks or bonds, mutual funds could be a great starting point. If you're an experienced investor looking for specific types of exposure or to diversify your portfolio, mutual funds can offer that too. In conclusion, mutual funds provide an opportunity for diversification, professional management, and liquidity. However, like any investment, they come with risks and the potential for loss as well as gain. So, if you're looking for diversification and professional management of your investment, you might want to consider mutual funds. Let's now delve into real estate. This investment avenue is quite distinct from the others we've discussed so far. It involves purchasing physical property, which could range from residential properties such as houses and apartments to commercial properties like office spaces or retail outlets. Real estate has a number of unique characteristics that make it an attractive investment option for certain types of investors. Firstly, it can provide a steady stream of rental income. This is especially true in areas with high demand for housing or commercial spaces. Secondly, real estate can also appreciate in value over time, providing potential for capital gains. However, like any other investment, real estate also carries its share of risks. Property values can fluctuate due to a variety of factors, including changes in the economy, interest rates, and local market conditions. Also, properties may remain vacant for periods of time, resulting in loss of rental income. One aspect of real estate investment that can be both a pro and a con is its illiquidity. Unlike stocks or bonds, you can't sell a property with a click of a button. This makes real estate a less liquid investment, which means it may take time to convert it into cash if needed. On the other hand, this illiquidity can also be beneficial as it can discourage impulsive selling during market downturns. When it comes to the type of investor who might be drawn to real estate, it's typically someone who appreciates tangible assets. They like the idea of owning a physical piece of the world, something they can see and touch. Additionally, real estate investors are often comfortable with long-term commitments, as properties usually require a significant amount of time and effort to manage and maintain. Thus, if you're someone who appreciates tangible assets and are ready for a long-term commitment, real estate could be your ideal investment avenue. Now that we've compared these investment avenues, let's summarize. We've journeyed through the terrain of stocks, bonds, mutual funds, and real estate, each with its own unique set of characteristics. Stocks, with their potential for high returns, are balanced by a higher level of risk and volatility. Bonds provide a safer harbor, offering stable income with lower risk, but at the cost of lower returns. Mutual funds strike a balance, offering diversification and professional management. Yet they come with their own set of fees and potential for underperformance. Real estate, on the other hand, offers tangible assets and potential tax advantages, yet it requires significant capital and may be less liquid than other options. Each avenue presents a different blend of risk, return, and liquidity. Remember, the best investment avenue for you depends on your personal financial goals, risk tolerance, and investment horizon. Happy investing!